What drove last year's emerging market bond performance, and is it sustainable? Hi, I'm Rebecca Chu Kwan, and I'm here with Daniel Shaykevich, Vanguard's lead portfolio manager for emerging markets and sovereign debt. We will unpack what advisors need to know about the forces behind last year's emerging market returns, how a weakening dollar could shape 2026 EM strategy, and where to find the biggest active opportunities. Dan, thanks so much for being here.
Thanks for having me.
So let's unpack 2025. There was both strong performance in hard and local currency bonds. What was driving that performance?
2025 was a very strong year for emerging market bonds. And a lot of this has to do with fundamental improvements. Countries have reduced their budget deficits, they've benefited from stronger growth, and actually a number of names got upgraded to investment grade this year. But there are also some unique characteristics of emerging market bonds that really helped us in 2025. One of the reasons that our clients allocate to emerging market bonds is that when you have a good year, you can really see outsized returns coming from EM.
A really good year. So let's talk first about hard currency bonds, dollar-denominated bonds. What was driving the return in that sector?
The special sauce for dollar-denominated emerging market bonds is the unique combination of wide spreads and longer durations. You really can't get that anywhere else.
Mm-hmm.
In US investment grade, you have longer durations, but you don't have a lot of spread, so you don't benefit from spread compression. In US high yield, you have wider spreads, but you don't have much duration, so even when spreads do go tighter, the impact on prices is very limited.
Right.
But emerging market governments tend to issue bonds for longer maturities. So when you lock in those bonds at a wider spread and those spreads compress, there is a significant price appreciation that investors benefit from.
You get the best of both worlds. So what about local currency bonds, which we also hold?
Local currency bonds accrue at often higher local government yields. Additionally, when those currencies appreciate against the US dollar, investors benefit from that price performance, and this year, that was certainly the case.
So Dan, you've said one of the other drivers of returns in emerging markets are capital inflows. Tell us more about that.
Returns further supported performance in EM in 2025. In the prior few years, much of the money coming into EM debt came in indirectly, with managers managing broader bond mandates, allocating a portion to emerging market bonds. But in 2025, investors allocated to EM bond funds and EM mandates directly, preferring to focus more of their investments on emerging market debt.
So it was a pretty remarkable 2025. Can that momentum be sustained in 2026?
We expect a good 2026 for emerging market bonds. There's still plenty of improving stories, and overall yields remain attractive. However, we expect more of the return to come from the carry component of EM bonds, as spread compression in a number of names is limited from these levels. It's also going to be very important for an active manager to separate the good stories from those that got lifted up with the tide, and making sure we avoid the credits that may not be going in the right direction.
So what about the dollar? You mentioned the weak dollar in 2025. What does it look like for 2026?
The weak dollar has come a long way, which is happening just as the U.S. growth is actually in the process of picking up, and U.S. yields remain well above most of their developed market counterparts. So we'd be careful expecting much more weakness in the U.S. dollar. However, the existing strength that you've seen in emerging market currencies can translate into lower inflation and give emerging market central banks room to cut interest rates. And that creates opportunities in local markets.
So Dan, one of the reasons that investors invest with Vanguard is for our institutional quality active management. So where do you and your team see active opportunities in 2026?
For 2026, we're looking for a combination of offense and defense. Offense is about maintaining overweights to the positive fundamental stories. But defense is about picking bonds that can have positive excess returns even if spreads go modestly wider. Often you can find that in intermediate bonds in BB and BBB credits. Of course, as an active manager, we're always looking at opportunities the market provides us. And given everything going on in the world today, it would be a surprise if we didn't get some of those in 2026.
Dan, this was really fascinating. Thank you so much for your insights.
Thank you for having me.
Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.